Welcome to the Buy Side Brief, the podcast that digs into the strategies, challenges, and successes of tried and tested equity investors, whilst unraveling ideas, trends, and projections on the outlook of stocks and industries. Good morning, Shaun, and welcome to the podcast, the Buy Side Brief. And I know that we've been speaking for many years when you were back at Paradigm, but we never really got into your story. So it'd be great to understand from you today a bit about your background, and you obviously current CIO at Maat Group at the moment, with 20 plus years experience. So before we go into Maat Group, it'd be great to understand where you started. So in terms of where you grew up and your education, if you could talk through that, and then we could get into your early career after that.
Yeah, sure. Well, Lewis, thank you for having me. It's a pleasure to be with you always. I always love when we chat. I'll try and make it quick and painless on my background. I'm Irish, so originally from there, grew up there. I was born in Limerick, but we moved to Dublin, the capital city, when I was quite young. Went to school in Dublin. Ultimately, I went and did a degree in economics and business at Trinity College in Dublin, which if no one has ever visited the Dublin city, you should go. It's right in the centre. It's really beautiful, very scenic. They've got the Book of Kells there, so I'll advocate for them as a tourist spot. And then I wasn't sure I would be able to get into finance. I had always had a passionate interest in it, in investing and in finance, but I didn't know anyone in the space. Ireland wasn't really, especially at the time that I was there, wasn't a focal point for it. It was Ireland was on the rise, but this was back in the late 90s. To the extent that anything was happening there, it was tax related or audit related, and really nothing on the investment side. Back office maybe, that was about it. And so when I was looking at applying for jobs in London, which is what everyone would do, I wasn't sure that I would be recruited. And my sister told me that there was a program in the mathematics department, even though I hadn't studied mathematics, called high performance computing, which in simple terms was just parallel processing. So what Google now does, and you see it everywhere, Amazon Web Services, at that time that was quite innovative. But there was a finance stream within that you could do. And I thought it would be useful to learn more financial math and useful to learn that kind of mathematical way of thinking. And so I talked them into letting me into the program. So I think they took me in as an experiment. I remember it well because they had a refresher in programming in the programming language C. And I made a joke when I got into the lab, and I said, "Okay, what happened to A and B?" And I mean, absolutely, nobody found this funny except me. Did not understand, and I was really at a loss. So I'd never programmed in my life before, so that was really intense. So that was about 100 hours a week for about a year that I was doing that. Then I started applying for jobs, and I applied to most banks. I only got responses from two, and they were very far apart. The first one was Deutsche Bank. And then about 2 weeks after that, I got a call from Goldman, and they said, "Look, why don't you apply for an internship? We do that here, and you'll almost certainly get it." So I flew over with my girlfriend then to London just to have a day there, went in for the interview, and that went really well. So I got an internship there. That summer I went to London, so that was the summer of 2002. And it was pretty interesting. I went in and I did not spend a lot of time around the precious metals desk. I got offers from a couple of different desks. I ultimately elected to go to the high yield trading desk. I think it's what everyone wanted to do. And that was great. But it was an interesting experience for this reason. So this was the summer of 2002. Obviously the dot-com stuff had blown up. People forget that the European high yield market was a very new thing and had been almost exclusively focused on debt industries, so kind of tires and other things, and then the build out of TMT. So people have forgotten this now. We're building on all of the fiber, everything else. It was a massive capex program. People forget that Vodafone was worth 300 billion at one point. These were enormous valuations. It's the same way we're talking about Nvidia today. That's how caught up people were, and the European high yield market was built for that. That, of course, along with the dot-com boom collapsing in the US, was collapsing in Europe. So by the time I got back, they asked me to start early. If you know Goldman's or their old office in London, they had Peterborough Court, just off Fleet Street. They had these two buildings combined, and the trading floor, I think, was on the second and third floor. When we were there in the summer, both sides were completely full. When I came back, one side had been let go. So like half of that floor had been fired. So I remember saying to my parents, it was like a neutron bomb had gone off. So my introduction to the finance or the markets was a rude awakening. So they moved me into the capital markets group, and I really did not want to do that. That's kind of very long banking hours, dealing with that. Capital markets is more, it's kind of between banking and trading, and it's the worst of
Sure,
all worlds, in my opinion. I was
sure.
very lucky, though, because the guy running that group was a fantastically charismatic person called Timothy Flynn. He's great, a fantastic person. I did a decent job, and so Tim was very kind to me. I told him actually after a drink when we closed the second deal, I said, "This is not for me. It's not what I want to do with my life." He was great. Like I could have a very open, frank conversation with him, and I said, "I'm going to quit and go back to Ireland because I
Sure.
miss home and I miss my friends. I had a great social life there." He's like, "Look, just go to New York for training. You've had a hard, like, 9 months, whatever it was, or 8 months. Just go to New York for training. Enjoy yourself. Don't worry about whatever. You'll get rave reviews. Just enjoy yourself." Because I had worked harder than most do. I
Yep.
guess the first few months that you're there, and little did I know he had been very kindly saying to people back in New York, "This guy's very good. Don't let him
Yep.
leave." So when I got to New York, yeah, I went over for training and I loved it. Had a great time. And I got out with the two ladies from HR who were running the analyst training program, and they
Sure.
said, "Would you consider a job here?" I said, "Yeah, of course. New York's amazing. Is it always like this?" They were like, "Yes, it wasn't." But I said, "Yeah, that'd be great." And then they had me set up with interviews. I think I got offers
Sure.
from three of them. Really lucky, and the one that I picked was again, thanks to Dan Sparks, was
Yeah.
mortgage-backed securities trading. So like they gave
Yeah,
me
because
the
I saw you done that for a good amount of time, and then yeah, firstly, very jealous that you've had the ability to go and work in New York, and then obviously starting in London, and now obviously in Germany. But yeah, from my understanding, you spent what the best part of 7 years or so in commercial real estate, mortgage-backed securities, heading the desk over at Merrill Lynch after your time at Goldman around the period of the GFC. You actually one of the first to understand we're in a mortgage bubble. But yeah, if you could talk about what that was like and the environment and your experience there firsthand.
That was in my late 20s. So I started getting offers from lots of different places there, and from some buy side firms too. So literally just in the right place at the right time. I didn't have
Is that
any.
kind of the transition to get to Merrill Lynch? Sure. So you
Yes.
go on to head up that desk there. Is that kind of did you land there as head of team, or did you kind of come in and then work your way up?
I was hired in originally to do just single name CDS and only for
Yep.
CMBS, and then they yeah within a with that ended up being a lot more profitable than they expected. So the budget that they'd given for the first year, I think I hit in the first 3 months or something, or first 2 months. And then they had
Sure.
a correlation business that they've been trying to get going for 2 years, and it
Sure.
just hadn't taken off. It was kind of killed in the crib by the CDO business that existed. They were scared of it. And they just handed that to me because they thought, well, no one's going to be able to do anything with this. And we were able to turn that around substantially. So, yeah, we started getting going in 2006 with that. So
Sure.
I moved, I think it was late '05. So it was about a year, from the mid '04 stuff with the ABX and CMBX was about a year or so more that I stayed at Goldman. And then finally I
Sure.
was looking at different offers. I went to Merrill because it had the biggest distribution force. So that was that. And so I had single name CDS for just CMBS, and I had mortgage correlation for all mortgage products. That was given to me there. And then the next few years we did well. So we were positioned correctly, I guess, going into the GFC.
Just very quickly on that, when you come into the GFC, we were one of the first to understand that we were sitting on a mortgage-backed security bubble. What was that like to experience that firsthand when you were, you had this understanding that most around you didn't? How was that received by the wider bank and even potentially some of your clients?
Yeah, not it wasn't pleasant, to be honest. So it's we had a really successful run, and I should say it's I was on the desk, but there was Julie Imus, Grace Park, and Ed Kotler who were with me, and Julie was with me pretty much from the beginning. She had moved over from corporate correlation. She's amazing. She's now a very senior person at Swedbank. Grace Park likewise. She's running. I think she's running the resi financing business worldwide for Barclays now. So they've gone on to great things, and Ed was excellent as well. He came in later, so it wasn't me alone. Just to be very clear,
Sure.
but we were all pulling the same way, and that was a big thing. We were all on board. I didn't dictate anything. We had similar views. So within that group, it was a really positive experience. I think we
Sure.
understood what was at play. We understood that the market was likely to break down. I think we had a good rationale for it, which I can explain. But as an experience overall, it was extremely unpleasant.
Sure.
First of all, I
I suppose
really looked.
as a better question to ask you, and sorry to interject, is more the idea of how did you come come across the fact that we're actually sitting in a big bubble when everyone else was unaware of that? What, were you going into the tranches and doing a lot of the analysis of what was actually in these loans and mortgage-backed securities, or
Yeah.
yeah, what led you to that conclusion?
Yeah, it came from both angles. So first of all, going back to Goldman, because Arcom was there, which is an originator of loans, and because they hadn't been so great on the trading side, I really, and I didn't know anybody in New York. I would come in early and leave late. I would often get in at 6:30, and I would leave at like 1 in the morning. Not all the
All
time,
right.
but often enough. And I would offer to help anyone who was there, or just to learn. So even if they were doing like a lot of grunt work, which is most of what I did, that'd be that. And part of my job on the commercial real estate side was when they were closing a commercial loan. So if they were giving one for a shopping center or an office, the guys who were there, and it was great. It was Roger Brune, Andy Reichen. They were amazing with me. Really amazing. These two guys who kind of headed this group under Mark Buno, who's a genius. Mark Buno is an absolute genius. He's retired now. Again, someone who was really kind to me. He's a professor. So they would control all the economic decisions for Arcom, which sat down in Texas. But they would have me on the calls closing the loans. And I would have to read, there's a whole, like there would be for an investment committee at any firm or private credit firm today, there would be a whole loan packet that went with that. So the day
Sure.
before, there might be 5 loans closing or something like that in the next 2 or 3 days. I would get these loan packets, and my job was to read it and be prepared and ask questions. Now, I wouldn't ask on the call most of the time until that a year in. But they knew every game that brokers played. There would be external brokers trying to get Arcon to give a loan, that borrowers play, what you have to do in terms of due diligence. So I really understood how the sausage was made. And they had told me all sorts of stories about different ways that people had gotten around the guardrails that are in place. So I understood how the sausage was made on the loan side for commercial real estate, which is quite unique and more prone to this. I also understood how it was done on the resi side, all the way down to scratch and dent. So these are people who've defaulted many times. I knew what the standard differences were for Alt-A and subprime because I had seen the exercise and the data tape that they go through there. You're seeing a similar thing now in auto loan receivables. You cannot check every one of the loans, so they do some statistical sampling. So I had seen how that goes around and how it could be gamed. We would talk about that all the time. We were the ones who could be gamed, so we were wary of it.
I think that's a really interesting experience, and quite a historical event. So throughout your career, how do you make the shift from a different asset class, be it the debt side of things in real estate, to bottom up stock picking? So how do you make the transition?
Well, I guess it's all related. So we did quite well out of that, again, because we'd understood it fundamentally. We'd actually gone and studied the accounts of the monoline insurers to try and figure out when they would run out of capacity. We got so concerned about it because they were counterparts for some of the trades that we were short that we went out and bought CDS protection against our counterparties. We got in trouble in that at the bank at the time. They had a centralized counterparty trading desk who didn't believe that these problems would be as manifest. I mean, they changed their minds later on. We were very lucky, so we were able to make sure that profit was fully bookable. So even if someone went away or they got into trouble, we got paid for it. So from that, I'd always been interested in investing more broadly. I like looking at corporates. Obviously, I started off on the high yield desk originally at Goldman London. It was just a short-lived thing. So I wanted to do something more expansive. At the end of '09, I was just exhausted, from going through the merger
Can
with
imagine.
Maryland B of A. I had a good position there. It was kind of a sinecure, but B of A was more siloed in terms of how risk was going to be taken. And more, it felt to me more bureaucratic. And I just honestly, it had been so overwhelming for 4 years, and my mother had just passed. I just wanted to do something different, take it a little easier. So moving to the buy side, I don't know if that's taking it easier, but that was the idea.
So when did you actually make the switch to equities then?
I just wanted to do something different in my life. I really wanted to understand how to appraise a business. My uncle, who I was very close to, who's a very prominent, well-known physician in Ireland, had just died as
Okay.
well.
All right.
And I had been with
Sorry
him
to hear
actually
that.
when he passed. Oh, it's okay. And he had asked me, just like, if his boys ever need some financial advice or come to you, please be helpful with them. It was a passing comment, but at a very emotive time. And I really, I mean, I see him like a second father. I still miss him.
Sure.
But it occurred to me, I'll never forget it, that night, what advice could I give them? What use of, if I was saying it to you, Lewis, like, do you want to buy this CLO? It's cheap, or the Class C of GSMS 07 GG1. Like it doesn't help anyone. It's an institutional
No.
product. And I wasn't able to trade those products for myself. So I could deliver outstanding returns for the people I worked for. Like in
Sure.
2012, I think we had 100% plus year. You know, we had made multiple billions over the GFC. I, no one in my group or my family really saw any of that money. Again, understandable
Mm,
Merrill Lynch, but it's just really tough. And then when I'm on the buy side and I'm seeing these things that, like, I was buying stuff in 2011 that had been trading at 85 cents in April of that year. By September, we're buying it at 5 cents, and 3 years later, it's at 30, and it's paying 5% a year itself. Like, it was ridiculous. It was a once in a lifetime opportunity, but I'm not allowed to participate in it. So I could be a participant in the overall fund, but not in the overall thing. So I really was craving independence, and also I had been, you had asked the question earlier about the GFC or leading into it. Everyone thought we were crazy in 2006 for being worried. All the way through the failure of the Bear Stearns funds, we were heavily involved in that in doing the auctions for every CDS contract they had. The whole way through, you're mad, you're mad, you're mad, and then afterwards it's obvious, and you're making a lot of money for the bank, but everyone else is losing. It's just not a pleasant environment to be around. So
no.
it had been so unpleasant, and everything had been second guessed. And I think, you had asked me this before we started. I think a lesson for everyone is, and just get used to it if you're investing, you're always going to have a lot of really smart people who disagree with you. You're always going to think that you're just doing the wrong thing. And, it's not who they are, it's not how established they are, and it's not whether their opinion sounds good or bad. It's just, are their facts right or wrong? It's as simple as try to make it less emotional.
Being in New York for some time and gelling with so many different people, how do you end up back at back in Europe, Paradigm? Where did that? How did that come about?
A friend of mine, a guy who was the other Irish intern at Goldman many years before, the same year, he had followed a similar career trajectory. Brian Hatch, he had
Hmm.
run. He'd been the youngest person ever to run the Eurodollar desk at J.P. Morgan. Left, got sick
Okay.
of it, went back to business school, to Columbia Business School, which specializes in value investing. And I think he was the favored student in the class. So the
All
person who
right.
ran that school for 20 plus years, a guy called Bruce Greenwald, very famous in the
Okay.
value investing world. He was chairman of a fund in Germany called Paradigm. So he suggested that Brian go there. And it was a very interesting A/B test for me because I saw Brian go. I actually offered him a job at Bluecrest when he
Okay.
was coming out, and he didn't want it. Very wise. And I set him up at DW Partners. I think they did want to hire him, but he elected to go to Germany instead because Bruce recommended it. So I got to see him, and I could compare him with the analysts that I saw at DW and at Bluecrest. And these were really extraordinary analysts, look exceptionally good, right? So like top notch. And I saw, he was behind to begin with. After a year, so I think it was 2013. After a year, he was ahead of them. And I was like, that's weird. I would see him every time. He'd come back to New York once a year to visit his in laws with his kids. And I said, okay, that's weird. The second year, he was way ahead. And he was a generalist, so he was covering all different types of industries.
Sure.
And the third year, I didn't know what he was talking about. So I was like, I said, what is it, something in the water? What's going on over there? And he goes, no, the guy who ran the funds, a guy called Jan Hummel, who's a brilliant investor, Paradigm Capital AG. Jan and Paradigm, they're fabulous, okay, just for the record. So they do a great job. I said, I've got to meet the guy behind this. And Jan was very unusual, but he was going to be in New York the next week. So we had
Okay.
breakfast
Good
together.
timing.
Yeah, and he gave me the pitch. I think he thought I was going to be an investor. And we sat down and he just went through it. And Jan had a very unconventional background. He had kind of grown up picking stocks as a kid in Sweden, in the middle of nowhere, in like a socialist country. And then he'd gone off and he managed to go to Harvard and Stanford, and just a really accomplished man. Came back, went into investment banking for a while, didn't really like it, like I think for a few months. And then he goes, people don't realize this, there was like a depression in the Nordic area, particularly in Sweden
Okay.
in the late 80s, early 90s. He went in and basically did sweat equity, get loans off the bank. And I've got the upside for, I don't know, 12 businesses. I think 4 or 5 of them paid off. So he had
Hmm.
actually been a practical CEO and lots of
No
different
way.
things, like a lumber furniture business, a pharmaceutical business. He's done all sorts of things.
That's really
But he really,
interesting.
yeah, he thinks like an operating manager. So think of it like a sweat equity, private equity guy who's gone in and
Sure.
actually been an operating CEO in lots of
Okay.
different industries. He just had a totally different conception and approach to anyone I'd met, and
Mm.
he really understood it. Like it wasn't theoretical, it wasn't some philosophy. It was just like let's buy things cheap and make a lot of money. And I remember asking Brian, I'm like, what is it about the guy? And he goes, I'm not sure. The guy just has a nose for money. He can make money. So I said, I wanted to meet him, met him, and then I said, look, would you be interested in hiring me? And he said, I don't know. And I said, I'll make it really easy. I'll take a 50 to 1 pay cut. So I'll take the same pay as an entry level person coming in, and I'll come for 2 years. And the quid pro quo can be this: I will help to professionalize certain things or show you what happens at the bigger funds. Maybe there's some other things I can do with a prime broker or something like that can help. And I can just, the messaging, how we would message the institutional clients, probably different to the client base you have. Maybe that can help too. And I'll do whatever I can, and in return, I learn how you value businesses, and I'll be on my way after 2 to 3 years. That's that.
That's a really interesting proposition.
Yeah,
And given that you were obviously there for 7+ years, I assume that he snapped your hand off and took the offer.
yeah,
Did he?
yeah.
Did he
Well,
pay you as little as you proposed, or I suppose
no,
that's
he was no. Jan was really good. No, Jan was really good. So actually, what happened was I said okay. He said maybe, and I said, are you serious about this? And I said, well, I'd like to spend a week there. Is that okay? He said, yeah. So I came over. I spent a week there. My wife came over for the last 2 days, and Jan is incredibly charismatic and charming, as are his whole family. And I really loved the group that I met. And actually, everyone who was there has gone on and done very well. So like some people have left. Bruno Carrero has left. David Jackson has left. Bruno's got his own fund now, long short, I think 400 million AUM. And David's very senior in legal in general. I think he's running European equities or something like that for small and mid cap. So like that small group, and then Rahul was there as well. And Rahul's obviously now with us at Matt. So that
yeah,
small cohort did really, really well. So really good group. And again, Jan just had an instinct for business. It's very different to
sure.
how a lot of investors approach it. That was the draw for me. He was a generalist. He was looking at lots of different types of business, and he was doing it with the owner mindset. It's the very thing that
Sure.
Munger used to talk about. So where can you find that these days? Nowhere. So yeah, I went over and did it. So yeah, like he did. I did take the first year. My salary was X, but he then paid me a very generous bonus, and then my
Nice.
salary escalated every year afterwards. And yeah, by the end of year two, he pretty much made me a partner. So
Sure. Yeah, I saw that actually, and spent what 7+ years, as I mentioned earlier. So a question to ask you that's quite a direct question is,
yeah.
being at Paradigm for 7+ years and having a strategy that delivers very well, from my understanding, on the performance side. Why not stay at Paradigm and continue to be a partner? What was the reason for wanting to form and launch Mart?
Yeah, I honestly I didn't want to leave for the longest time, and I've been trying to find a way around it. So this is not something that came as a surprise to them, I hope. So Jan and I had quite a few direct conversations, really from I would say the end of 2021, early 22 onwards, where there were certain things where we were increasingly at odds with each other, and this was about nature of the team and who was doing what. First. Secondly, it was where to focus the risk in the book. I increasingly had an opinion. I was managing a small sub portfolio within it. That was the first time that had been done at the fund. Brian had stepped away to manage the North American fund, so his focus was less there. And I felt
Sure.
that we were just moving away from what had made the firm successful. I was also, apart from that, I was very concerned about certain exposures. And finally, I did not see a trajectory for the very talented people at the firm. So it was okay for me, but for the more junior people, the sense I had was they felt very stifled.
Sure.
They did not see a path to becoming a partner or to becoming head of research or to managing money, which is what they all ultimately wanted. And I thought that Paradigm had been very lucky to have Brian in particular, myself to a lesser extent, but it was unlikely we're going to get that lucky again. It's hard to find people who had kind of this very strange approach come in, mesh well with a guy who's got a lot of operational experience. They learn, kind of like lightning hitting the same place 3 times in a row. Just seemed a little odd. And there was there was no meeting of the minds on that. So like I was increasingly vocal about this from I would say start of 22 onwards. I'm really concerned about X, Y, and Z. Up until that point, it had been going very, very well. And we couldn't get to agreement on it. So I said, look, if you do not have a path for someone like Rahul, you mentioned his
Yeah.
name earlier,
Yeah.
he's not going to stick around. Like he'd gone away to Temasek for 2 or 3 years beforehand. They were dying to have him back. There's so many hedge funds in Singapore, in Hong Kong, who would literally tear his arm off to get him. He's so talented. I mean, you've spoken to him. He's such a brilliant
Yeah.
analyst.
Absolutely. Yeah.
So you have to make it appealing for him somehow. Why won't you? And I think Jan intended to, but it was just moving too slowly. So that was it. Patrick had been frustrated about other things. He left. I was closest to Patrick. I mean, of all of my friends within Paradigm, he was the one that I
Sure.
was really closest to. And he was in operations. I mean, I cried the day he left, and he left about a year before me. And that was really rough. And I think it was just Paradigm was a very hardworking place as well, but it could be quite intense. And sometimes there wasn't always I think the appropriate sympathy or empathy for someone doing the amount of work that he was doing, for example. So
Sure.
certain people I felt did not get appreciated the way they should.
Yes.
Others I thought were getting more appreciation than maybe they deserved. Maybe that includes me too. And also it was just when I have been taking risk, Lewis, for a long time.
Yeah.
When I got to Paradigm, it was under 300 million in AUM. When I left, I think if you included SMAs, it was north of a billion too. It might have been a billion five. There were certain things I wasn't
So good
privy
amount of
to.
growth there, and not just growth in AUM, but obviously yourself just first proper experience on the fundamental bottom up stock picking side, and probably learned a lot from Jan on the kind of private equity style ownership mentality. That my understanding, you've
Exactly.
taken that forward to Mart, right? So if you
Yeah.
were to introduce Mart, what would be the philosophy, the way you think about stocks?
Yeah, I think it's very similar. So we're not trying to copy what Paradigm does. I think it's true in the sense that we're just doing a lot of diligence in the companies. We want to understand them inside and out, as if we were going to own them for 5 to 10 years. And that's more from the Buffett mindset, which is just understand what you own, and then know what questions to ask, and think like a business person, not like a spreadsheet monkey who's trying to optimize some metric or something like that. It's really no. If you were buying the business and you have to own it for 10 years and you can't sell it, how would you think about it? We'll think about the path risk after the fact. So that's the approach we take. It's similar to Paradigm in that sense, but the way that we do research is different. The way that we integrate research into capital allocation is different as well. So we like to say that we've got the best of qualitative, which is all of the stuff about a business that is not contained directly in the numbers. You can infer it from management behavior, historical capital allocation, the strategy they have, what's going on with the industry. Everyone has access to the same base materials, the annual reports, presentations, industry data. We all have access to that. But when you're looking with a 5 or 10 year horizon, capital allocation really matters. Who's making those decisions? What the strategic outlook is for the industry. Those are more qualitative assessments. It takes a lot of time. So I think how we do that is slightly different. The way that we do it is everyone's got to prepare a very large primer report for everyone else in the investment team. They also prepare a model that's fairly easy to use. The idea is not for the model to be ultra precise. We see things as very much probabilistic. It's for it to be easy to use and easy to parameterize, right? So it's got to be close enough to reality, but that it's informative. And the reason for this is we don't want the discussions that people end up having in an investment committee or a research focused discussion. It's usually very passive, and it's usually almost theatrical. So people are going in, they're just waiting for their turn to speak. They're half asleep. They've got one person interrogating them, maybe the CIO, and that's it. They're going through. Otherwise, you might have it where people are encouraged to ask some questions like it's a business school class, but that's very much just for scoring points. It's not really done with any end in mind. It can create quite a combative structure, and again, you're getting very
Sure.
passive engagement from almost everybody. What we do in this case is we want people to disagree. We want people to be open about what they think is wrong, but how we go about that is different. So you've got to read this primer report, and the primer report is not a pitch deck. It's not some pitch for a stock. It is the good and the bad. It's if you were buying the business with me tomorrow, you were my partner. I've studied this for 3 months. Can I write anywhere from 10 to 50 page document that gets you up to speed? You can go and check all the sources if you want, but gets you up to speed so you know what the most important variables are and why for the next 1 year, 3 years, 5 years, 10 years. Can you have an informed discussion? And then related to that, we send you the model. And you're going to parameterize your own version of the model. So to the extent that you disagree, let's say we were talking about a car company or car OEM, you disagree with what the unit production volume is going to be in the US and what the margins might be. That's fine, but you've got to parameterize it yourself, okay? So for every one of these that we present, we've got 3 scenarios prepared. We always tell people they can approach valuation any way they like. If it's real estate,
Okay.
maybe it's value per key if it's a hotel. If it's office, maybe it's cap rate. If it's retail, maybe it's sales per square foot and whatever take rate you get from that. Ultimately, though, any of those approaches you can convert to a DCF, right? All of them are
Okay.
fungible into a DCF. Likewise, if we were looking at an oil rig company, we might look at EBITDA per rig or something like whatever the metric is, replacement cost, whatever's most appropriate for that asset, do it, but convert it to a DCF. You've got 3 scenarios, and you've got your DCF outputs, and from that you can
Sure.
derive
So
an IRR.
standardize essentially the
Yeah, and that
yeah.
allows us to track back to what the input assumptions are for each individual. From there, we can now have an active discussion. And so we have a research meeting where we're discussing all of this stuff. And again, to the extent that you disagree with me, you come in and say, okay, I disagree, but here's where I disagree and why. And it makes it a lot less personal. It's not you having to
Yeah,
go,
a lot less combative, and more just around
exactly.
the narrative, the investment case.
It's just on the narrative and the investment case. So it's like we're just trying to get to the heart of the matter. it also forces some consistency. So, what I'd seen before, whether it was on the sell side way back during the GFC, whether it was on the buy side in New York, or even a Paradigm, there were instances where people were inconsistent with themselves unknowingly, and it's very easy for it to happen. So I will make an assumption. I feel very negative about a business I'm looking at in Ireland, for example. I'm going to assume revenue growth of 0. I'll look at another business listed in Sweden that has 40% of its revenues in Ireland, like a hypothetical case, and I'll assume revenue growth is 5%. There's an inconsistency there, right?
Yes.
It's implicit, and it's hard to identify, but it's there. Doing this process for everyone, so the other person who might have looked at that Irish name, they will point that out. They remember it. They're like, wait, yeah, but we're negative in Ireland here, so we've got to adjust the numbers. The idea is we're just trying to create a lot of catching nets for different blind spots we may have. So the idea is just, look, if we can remove every blind spot, which we can't, but if we can try to, we've got a lot of nets. We're going to not make so many elementary mistakes. We'll still make some, but we'll catch a few, and we'll do it in a positive sense where it's not a personal attack, it's coming through. So that's researching the individual name. Where we get quantitative and what we're trying to do differently, I think, to most fundamental funds, that's on capital allocation. So again, one of my pet peeves is when you ask people how do they size positions or what are they doing, you get generally very poor answers and not something you can learn from. So if you ask them, it's basically finger in the air. I don't know. It feels right to me. That's not a very reliable metric, and this goes back to my experience with DFC and correlation trading. In effect, is all sizing anyhow. Because your emotions change from time to time. I explained before the call, my mother was terminally ill during the GFC, right, from late 08 to early 09. My emotional range was enormous at that time, and it had nothing to do with volatility in the markets. So, she would have a bad day, she would have a good day. My emotions would change a lot. If I'm relying on the conviction I feel, the emotional conviction on something, it's not.
That's not. Yeah, it's going to change based on emotion rather than actually just looking at some kind of defined framework.
Correct, and I think it can be even worse with equities because there are so many narratives you can assign to what's gone on. You can look at a price move in equities, for example, and you can concoct any number of reasons why that happened over a year or 2 years or 3 years. You can usually associate revenue growth and else, but you can say, oh, now the market is pricing this in. Nobody really knows, but people create narratives all the time. And it can be the wrong narrative, right? So it's very easy to fool yourself. So what we're trying to do is get away from the major behavioral biases that blow a lot of funds up, because we're focusing only on European small and mid-cap stocks. We do that because it's a universe we know for a decade. That's the only reason.
Okay, yeah,
so
makes sense.
That's it. But if we're doing that, to be successful, most of these companies don't grow very aggressively. The base rate, very few make it out to being multiple billions, but they are quite volatile. So to be effective and to generate high returns, we have to do what? We have to concentrate on the good ideas when they come around. If you're going to concentrate or have conviction in that way, you've got to be very careful not to make mistakes. And that goes back to being a bond trader. Like, the way to be a good bond trader is to take very few losses, right? It's to minimize the downside. So capital allocation is different. Where we take the outputs from the research side, those IRRs, we factor that into a model, and then we have to parameterize a covariance or correlation across the various things that are open to us. Okay. And that's when we will look at historical correlations. They're typically a bad measure. So I'll give you an example. If you looked at Kindred Group, which is a gambling company, you might know them as Unibet.
Yeah, we discussed that before, actually. Yeah.
Yeah. So I don't know if if you bring up a stock price chart, if you've got a screen in front of you, look at what happened to that from mid 2019 through April 2020, and I think it went from 120, 130 or something like that to 19 or 20 at one point.
Yeah.
Right, and so at 20, I think it was valued at about 400 million pounds, and there was no reason to think it wouldn't make at least 250 million in the next year or two, and it was going to return a lot of cash to you. So that's a position I know, say, for Dino, who's my partner. If you look at his track record, it dominates performance. It was the same at my former employer. We had a big position in this as well. We made, I think, 6 times our money, right? So overall, including dividends, in around 2 years. When you see something like that, you need to go for the jugular, right? And there was no risk here of there was no leverage there that was a problem. There was nothing like that. You can go look at the financials afterwards.
What was the issue with the business? Why did it take such a sharp decline?
Well, people weren't sure initially how customers would react to COVID. They weren't sure if people would stay home, if they would spend money, if they would be given state money. They weren't sure if people would, I don't know, I guess become monks or something like that. They wouldn't drink, they wouldn't gamble. There was a lot of fear. And really what happened between 60 and 20 was, I believe, one fund, which was a quantitative fund, was being liquidated. I think it had a margin call.
Okay, interesting. So there's nothing that's fundamentally impacting the long-term side of the business.
No,
If you
no.
assume that it's difficult to assume at that time that COVID will be something that lasts for a short period of time, and things will return to normal.
Yeah,
So
we
yeah,
we did that analysis actually. So you could do the burn down analysis, which is okay. Assume that they get no new customers and they start churning through the existing customers more rapidly. That's
sure.
fine, but then you just stop all marketing spend, which was a huge. I mean, it's the biggest expense that they have, other
Yeah,
than betting duties. So if that was the case, you're going to be paid back in 2 years anyhow. You would have
yeah,
to have a churn
sure.
rate
So,
unlike
so
anything anyone had ever seen. So yeah, there was a little uncertainty, but that's one where you could go for the jugular. So what we're trying to look for is if we see something like that, and it's always defined this way, where the downside is extremely limited and the upside is fantastic, we bananas. And that's where tying everything together. If you go back, the Big Short, if you like, during the GFC, where did I make the multiple billions from? I had the same trade on. I just had it in commercial real estate rather than resi.
couple of questions on that then. So with Kindred, for example,
Yeah.
how do you get an indication of how you position that particular investment relative to the rest of the book? You've done your homework and you realise there's a lot of upside. So what's to stop you from being quite emotional and having that as a very big proportion of your book? Not that that's a bad idea, but how do
Yeah.
you go about that in a
Well,
thoughtful way?
I think often the emotions are going the other way. So when this thing declines from 120 or whatever it is to 20, if anything, it's much harder to pull the trigger. So like the emotional thing is where does this end, right? You can get to a very irrational price,
Makes
and
sense.
that's where it comes. We come back. So we use a modified version of the Kelly criterion, and we have a very simplistic approach, which is we just look at opportunity cost. We have a hurdle rate for our capital. It's pretty high. It's above the hurdle rate that we get charged fees on, but it's pretty high. And if we're not above that hurdle rate on a given idea, we're not investing in it at all. For everything else, so if we look at the portfolio now, there might be 6 names in it, and it's only that. There's a seventh, it's tiny, but it's only a tracking position. We're ranking them against each other. So for all of those, we think we're well in excess of our hurdle rate, and then it's a case of force ranking it. So you said it there in the case of Kindred, if we went back to that, when it gets to 20 a share, we thought there is no chance it's worth anything less than 80. It's probably worth 140 to 200. Depending on what someone pays for it and what goes on. There were some events that could happen in Holland in the next few years, which did happen in Norway. So like there's always uncertainty around this, but no way it's worth less than 80. So it's 4 times the current price. Okay, well, in what time frame is that going to pay off? We can check that same measurement against everything else. What are the odds of trades to say 15 or 10? So we're down 25% or 50%. And how long would that happen? Again, at the rate that they were earning, they could just buy back shares or pay dividends. You'll be paid back in a year. So then we will be 30, 40% perhaps if we see something like
Sure.
that, because it's a once in a decade or perhaps a once in a lifetime in that particular sector
Makes
opportunity.
sense.
The key is can you identify it? So where does it come into play? Here's where it's more difficult. In the case of Kindred, what happens when it goes from 20 to 80? Now what do you do? Let's say that you made it a 20% position, right?
Yeah.
And the rest of your book has maybe doubled. What do you do when it goes from 20 to 80? That's where it gets a lot more difficult.
That's a good point. I suppose you go back to the valuation of where you believe its true value is.
And that's where the Kelly criterion comes into play. So there's two
Sure.
elements to that. So if it went back to 80 and we think it was worth at least 80, maybe it's 120, 140, whatever it is, the fair value could be depending on X, that probably won't rank number one anymore. Like when we look at our expected
Makes
IRR from that
sense.
and we plug it in, maybe the IRR is, I don't know, 12% per year. If we have 3 or 4 other things that have an IRR of 15% per year, but don't have the kind of path risk we think could happen,
Sure.
just automatically, if we don't change any of the covariances or correlations, that's going to drop from first down to fifth. So the whole idea of us doing this, we use the Kelly criterion. And we don't pick a position size that the Kelly criterion recommends. It's way too. The data that we're using is way too coarse for that. Okay, so it's
Sure.
like we cannot be so precise. But what we can use it for is to force rank the positions. Which one is the best? Which one is the worst? And we can position size accordingly. And always what we're looking for is downside first. Downside, it's important to define is where are we going to be after 2, 3 years? We will look at path risk in between because that's going to affect anyone's confidence in our judgment. But that's not our primary fixation. We've had that happen with a couple of things already where we bounce off what we think our low side is and it starts to appreciate. It's just the nature of what's going on. But if we see something like Kindred or like the credit IOs or if we saw like the Big Short in '07, we would go for the jugular. In other periods, we're going to have a much more evenly distributed portfolio. There will be There will be periods of time where we've got a large cash balance, for example.
Sure. And what? So a couple of questions. So one would be, so you've had the ability to short before, and that really helped you in the GFC. In your banking and the mortgage-backed security side of things. Why not short now, and have the ability to do that at Mart?
Well, we did a bit of shorting at Paradigm. When I first came in, Jan wanted me to look at that. I really didn't want to do it because it's a lot of brain damage on the equity side. So, it's absolutely true that I shorted both in the GFC. I could only lose a little, I could make a lot. Like if I gave you the numbers from the big short, the maximum we could lose was 45 basis points. We made par, right?
Okay.
So, over 201 payoff, and the odds were you were going to get the 200. The odds were you were going to win, right? So it was a pretty good bet. When you get that, you should always take it. Paradigm had shorted single names before, but it hadn't been very effective, and it wasn't a material part of what they were doing. It was, I think, less than 5% of the long book. It takes an inordinate amount of work. Just fundamentally, and this is my opinion, I'm not speaking on behalf of Paradigm. Obviously, I'm in a different place now. I think it is a mentally draining and perhaps foolish thing to do in our space, in European small and mid caps, to just actively short things. And the reason for that is things can go wild for a long time. You've got management teams who are heavily incentivized. Buffett used to talk about this. They can promote a story. They can even believe it. And they can keep the ball rolling for quite an extended period of time, long beyond when it economically makes sense. I think the people who did the work on Wirecard, get me wrong, they're absolutely brilliant. Fantastic analysis. They were right in the screws. It took a decade. And in the meantime, the thing went up to 100x. So where would we short? One of the things we changed the paradigm, for example, was let's think about what we're trying to hedge, right?
Sure. So where are you seeing the opportunity now? Obviously, we've talked about the past, COVID, things like that. Kindred, obviously, a great investment idea. There are particular pockets of the European small mid-cap market, which is where, obviously, you're focused. A particular sector or even an idea that you're thinking about.
There's still pockets of things that are very, very cheap. There's one where we just spoke about it. It'll come out next week, I think, at the Manual of Ideas, which is Meyer Mellenhof. It's a simple business. I don't know if you know it. It's a paper and packaging business in Austria. It's a family-controlled company. The family trusts around 58% of the shares. Had been a slow and steady, very, very simple, very reliable, very staid management team. So I think they had two CEOs over about 60 years, leading up to 2020, or over 40 years at least. And those guys have been with the company for 60 years. Had run with net negative leverage for most of that time period. Excellent positioning, very different to the US market in terms of packaging. It's much more fragmented. They were able to do a roll up there, if you like, just these kind of tuck-in acquisitions. On the paper side, they're the dominant, like the number one in Europe for recycled carton board. Carton board would be the stuff like if you go to McDonald's, if you eat like French fries or you eat a Big Mac.
Yep.
If you're buying perfume for your girlfriend or wife, the packaging there, that'll be carton board.
Okay.
Container board is the Amazon packaging, the brown stuff.
Sure.
So they are the number one in Europe by far in recycled carton board. For that to work, you have to be located close to big municipalities. You need a supply of recycled paper, in effect, coming through. So they are dominant in that area by some margin. Again, been very steady for a long time until 2020. They brought in a new CEO. Who was much more aggressive. I think at the family's request, they levered up quite a lot, did more capex in 3 years and more M&A in 3 years than they'd done in the prior 40. And unfortunately, they levered up to do it right as paper prices had peaked. So I think at the beginning of 2022, their new CEO, who'd run Mondi Packaging, Peter Oswald, he was voted industry CEO of the year for paper and packaging. By the end of that year, they were in trouble with covenants, or getting close to trouble with covenants on the debt. Paper prices collapsed. Energy prices went through the roof. They had some energy price hedges that people had not really understood that had rolled off. So their margins got killed. They actually went to be EBITDA negative in their carton board business, which is roughly half the business. Anyway, long story short, it's now trading at an EV of around 2.7 billion. We think the packaging assets alone, which is about half the business, are worth more than that. And just to give you reference, they sold some assets that they bought in 2018. These assets were in Russia and then in Turkey and in other parts of Eastern continental Europe. And they sold those at, I think just under 12 times EBITDA. And so the whole business, in our view of what normalized EBITDA will be within around 18 months, is available for less than 5x here. So you should double on an EV basis. There's obviously some leverage here as well. They're going to continue to delever rapidly. So you should see a multiplicative impact on the share price. So we think it's at least a double within 2 years, potentially more. I have some misgivings about capital allocation once they delever, that they might try and grow again through acquisition. But for the meantime, they've done a volte-face. So in December of last year, they came out and said, no more acquisitions. We're going to sell off this one packaging asset, which brought leverage down to below 2.5 times when it closed. And we are going to prioritize only maintenance capex and continue to delever. And they're also buying back shares for only the third time in the company's history, which is usually, that's historically been a signal that you're close to hitting bottom. So the issue with this one is, when does the carton board market in Europe normalize? We have a number of ways that you can get at that. We think it's very likely it happens within 2 years. It would be a big benefit if the conflict in Ukraine were to end. The sooner that happens for this business, the better. But it doesn't need to happen for them to be successful. So that's one example. There's some others in the software space.
And you think about that. So you're thinking, you've mentioned 2 years there. Do you typically like to make the majority of the value across a 2 year period, or because I understand you're looking to hold for kind of 5 to sometimes 10 plus years is the idea. Yeah. But I suppose you want there to be some kind of a catalyst, or you don't want to be holding to get any return after maybe 5 years, for example.
Yeah, no, we want to avoid that, but it's just you can't control the timing on these things. So like our ideas, we've got 5 or 6 ideas. Some of them will have a catalyst intertwined. It may come more quickly. So we factor that into capital allocation as well. Some won't. In this case, I mean, we could be wrong about this, but it would be a historical outlier. Typically, when the market has started to turn, so as utilization, and that's already started happening here, although it could dip again. But typically, when you get back to 90% and the industry's at 82%, profitability, pricing power comes back in. And so then profitability should shoot through the roof. It's very easy for this to re-rate quickly. I can't tell you when it'll happen, but it should happen. We had a similar situation with the Irish home builders, 4 years ago. They were at 85p, or cents if you call that in euros, for about a year. And then suddenly they're at 120 and then at 190. So we're always surprised by when the market catches up. It's often things that we would have looked at or thought about that we thought people would be ahead of. We'll give it 2 to 3 years, and we'll keep on updating. I mean, if they were to make a bad decision on capital allocation or make some crazy acquisition, we would change our mind.
That makes sense.
If they were to do some aggressive capex, we would change our mind as well. But outside of that, no, we think we'll be okay.
Sure. And then on the, every stock pick you've made, you've not always got them all right, and some that haven't gone so well or as planned. Would there be a key learning that you got from that? Something you might have missed or even didn't consider?
Yeah, I think there's 2 fundamental errors that I've made more than once that I want to avoid in the future. And those would be, the first one, which I guess there's no risk of at Matt, is when I take a top-down view of something. So if I just make an analogy from something else I knew, I take a high-level analysis and say that's going to happen over there. So just kind of loose inference, overconfident based on something I've done before or something that looks very similar. Usually the devil's in the detail and you get burned. So I've had that happen a few times where I just extrapolate from area A to area B. So anything where I was kind of like high-level stuff, I hadn't examined the assumptions. Ironically, I tend to be more confident in those areas. One of the reasons that we do a lot of in-depth research is, as part of doing that, you realize very fast your level of ignorance. Once you start getting into depth about certain different variables, you realize just how complex most businesses are. And most businesses are very complex when you get down to it. Also, how impenetrable they can be from the outside and how poor disclosure can be. So again, the primary reason for doing that research is not that we're suddenly going to know it better or we get a lot of conviction. It usually works the other way around. It's usually we're very respectful about what we don't know. We're also mindful that other investors don't know it. And then we're trying to gauge, do we have a differential in insight? So that would be point number 1. In terms of getting it wrong professionally and more recently in the equity side, it's been related to management. So, and that's misjudging management and misjudging their quality with respect to their honesty, integrity, and with respect to their judgment on capital allocation. So I have had situations where you go in, the person has an excellent historical record in capital allocation, and you presume it's going to go further, right? And instead they, or maybe there's a change in management and they become a lot more aggressive, say with leverage. So luckily I wasn't on the wrong side of this, but we could have been with Befesa, for example. It's a German recycling company. I thought the former CEO, who's now chairman, was extraordinary. The guy who took over a brilliant operator, but maybe not as good a CEO. And the CFO who took over had formerly been head of IR. Again, very polished at delivering the message, but not perhaps as disciplined as the former German CFO was, Wolf Lehmann, who's just gone into Gerresheimer. So that's one where when they were expanding to go into the US while they were expanding in China, that's one where I could see an upside case for that, say 40 a share. And I think it ultimately went to 60, but they were taking on too much too fast and integrating too much too fast. That's problematic. So had we been long that would have been a problem. We have had I won't mention the names. We've had situations in the past where we invested in something where it was, I won't say the name of it because I don't embarrass the person involved at the company, but it was a consulting company in the Nordics where the person was going through a pretty brutal divorce, which we found out like halfway through what had gone on in the person's relationship, and that person was still making major decisions on capital allocation, being quite acquisitive.
So difficult to find that information, isn't it? I suppose, and how that may impact someone's decision making, to quantify that, because that, when investing, a lot of the time you want to get the numbers right, but that type of thing is very difficult to understand how that person will react, and therefore how it will impact, likely negatively on the decision making side.
Yeah, and I think that's where it makes a difference to speak to people who speak to people who've worked with the company that you're, whoever the management team is currently. If you can find people who worked with them or for them before, if you get a chance to visit with management where they are, that's really great. There's so many different tells. You'll see it in the parking lot. You'll see it in how they treat people. If you can get out to dinner with them, there are lots of ways that people show their true self. The more time you can spend with them, the better. That's usually not available, but if you can do it, it makes a big difference. It makes a big difference. Even if we'll have calls usually every quarter with the management team, not because we're particularly focused on the quarterly results. We want to know about it, of course, but we're not fixated on it. We often get very favorable feedback because we're not asking the same questions as everyone else. It's a different focus. But you can sometimes tell by the body language what's going on with somebody. It's like when you meet your friends, you haven't seen them. It's like that person's usually very bubbly, gregarious. Now they're like, nil by mouth, looking down at the ground. Something is up, like it's no one's giving you any inside information, but you can register what's happening. And then
I suppose just on the side of being a founder and setting up Maat, you've got many individuals that are early stages of their career. Perhaps they're in a situation where you're at Paradigm thinking about setting up. From being set up for the past year or so, what would be kind of any challenges, unexpected challenges you've come across, or even advice you'd give to someone that's thinking about setting up, or even going through the early stages now?
Oh God, that's a good question. I would just say, what would I say? First, I wish I'd done it earlier. I never wanted to do this, to be honest, Lewis.
Sure.
I was offered the chance to do it several times when I was in New York, obviously during and after the GFC. It certainly would have been a lot easier than what we're trying to do here, and I never had the appetite for it. I didn't think I would do it here either. Really, it was Dino and Patrick, and seeing that they were so passionate about it that got me excited. So I think the earlier you do it, the better, if you can. The only proviso I would say is make sure that you're genuinely prepared. So make sure you know what you're doing. You've got a strategy that you believe in, that you can market, and that you can persuade other people, has some sense to it. Related to that, I would say it is a lot easier if you've got a track record. So we have Dino's, for example, because he did set up a company independently and get it audited. So we have that going on for 5+ years, which makes it a little easier. It's not very easy, but a little easier. And then I would say don't do it alone. So I've had friends who've tried to do this alone. I've got many friends who try to start a business and it fails. Usually they just took on way too much by themselves when it comes to this particular industry. So it is regulatory intensive. It can be quite expensive if you're trying to start a small fund.
Sure.
And rent a license or do whatever else. We went about it a different route. Obviously, we're subject to MiFID II. We're just getting our BaFin. We just got our BaFin license. I guess by the time this goes out, that'll
positive
be
news.
Yeah, it's great news. But it took that application. They had it for 7 months. It took 6 months to prepare it, so it's a year. So 1 year.
It's a long
from when
time.
we decided we would do it ourselves. Yeah, but to rent the license, you can do it from other people. Would be 8,000-9,000 euros a month.
God, that's a lot of money. Yeah, it's just to rent that. Yeah.
Just to have this kind of moniker. So it is a difficult thing to do in Europe. You can try and do SMAs and do it for non-European clients. I guess it depends if you're in Europe or the US, but I think that's quite difficult. I would say, again, make sure you know what you're doing first, though. I do think when it comes to investing that it's more of an apprenticeship than anything else. There's as much art as there is science to this. Uh, on the quant side, maybe it's slightly different, although I think there's more similarities than differences. But when it comes to what we're doing, fundamental value investing, or just understanding the business, being around someone who has run a business before, being around someone who has been on the board of directors, it's a different mindset to just looking at things, looking at a sell side report or looking at an annual report. When you're actually inside the business, you see that whether it's capital intensive, it's building drill ships, or if it's running a mine, or if it's a software company, ultimately it's just people solving problems every day. That's all business is. And it's easy to lose sight of that when you're looking at digits on a screen, or you're writing about something, or you get caught up in some narrative. You know, just think this is people solving business problems. That's it every day. So is the culture in that place good? Does it make a difference? Is it sustainable? All of those types of things. I think being around someone who's actually run a business, being around someone who thinks in that manner, it's almost by osmosis, right? Like any apprenticeship, there's so many different things you'll pick up. So I feel forever grateful to Jan because he had done that. Like it was a real eye opener about like the first thing he would focus on was very different to someone who had a spreadsheet focus. And the other stuff in terms of the accounting, you can learn that. There's so many online resources to do. Again, investing is so broad space. So if someone looking to do private credit, if they're looking at it, will be a different advice for that. I would say go for it if you're into it, but make sure you're prepared.
Final question on the investment side of things. Obviously you've got 20 plus years experience now. You've come from an unorthodox path when it comes to equities. Quite often you see investment banking or sell side research, or even getting straight onto the buy side. Someone that's just come out of university, or maybe first couple of years in the industry, is there any kind of advice you'd give them in terms of to best position themselves for a successful career in investing? Whether that be, certain skills they need to master, or, what they could do at the outset of their career that could really help them in the latter stages?
It's changed so much in the time since I started. So the advice I got great advice my first week at Goldman from a guy called Christian Sivajoti, who ran the prop desk there. And I asked him, I said, how do I end up at the desk everyone wanted to work on was the prop desk because you could do whatever you wanted. And I think it was the highest paid people as well in general. And he was a brilliant guy. He's actually I think he's profiled in the book. I can't remember which book, you can find it, but he's a great guy as well. He's a very nice person. He sat down for 2 hours. Anyway, his advice was, I said, how do I get to where you are? And he said, yeah, it's very simple. So from a trading perspective, if you've got a trading bent, the advice would be different. And that would be, go find any seat where you're a liquidity provider. And he said to me, it doesn't matter if it's repo, if it's commercial paper, trading 10-year treasury bonds, trading CMBS, trading equities, go where you're a liquidity provider, because nobody really understands liquidity until they're on the hook for it and making decisions for it. So that maybe be a special or something like that. So what do you do if someone comes and wants to sell 150 million or something, and you've got to make a decision to buy it or not? You could lose your job. Like there's no other real facet of life where you're going to discover if you're good or bad at that, or how to make that decision. You just have to have a lot of practice, a lot of repetitions. There aren't many seats for it, but what you find at the end of it is a real appreciation for liquidity. And if you look at all the great traders, amazing records, say Druckenmiller, you look at like any of them through history, they really appreciated that. Livermore, liquidity is kind of the basis of everything. That's very much the case in the very short term. And we think a lot about path risk at Maat, don't get me wrong, because we can get taken out. That's a risk for us with small cap companies. If the price declines by 50, let's say the price declines by, in the case of Kindred, for example, when the price declined to 20, the major risk there, if you invested at say 50, which still would have been a great investment, right? 3x your money.
Sure.
But the big risk at 20 is, does someone put a bid in 40?
And you've realised your loss.
You've realized your loss. So when you're dealing with small and mid caps, one of the biggest risks we face, for example, is that in effect we like to think we're short an option. We think about this nonstop. This is part of the equation. Why? Because I was a liquidity provider for many years. I had a huge balance sheet, and I would make these decisions. Where am I going to allocate capital? Similar to how a manager of a business thinks, I'm going to build for the next 3 years. Where am I going to allocate that capital? Just with a shorter term impulse. So understand liquidity, which is understand that things can change very quickly. This is the same advice that Buffett gives in different language. And his advice is, be careful about businesses that rely on the kindness of others every day, right? Who borrow every day in the open market. That's a play in liquidity. So I think if you're going to be a trader, get into a position where you're providing liquidity on a regular basis. Experience a few crises. These can be mini crises, whatever else. understand what that feels like, and learn about yourself. So, and I think that's the second critical point, and this is separate to trading alone, is the most important, I think, facet for anyone becoming a successful investor is understanding themselves, what their strengths are, and what their personality is like. You can be very emotional, you can be very calm, but you should be doing different things depending on what your personality is. If you are very high strung and very worried, maybe you should be looking at private credit, or you should be looking on the debt side, and you should be looking at something more secure like that, or on the insurance side, somewhere in that area where safety is the purview, right? So if you see the world as very much half empty, and that's your predilection, maybe that's the place for you to go. If you're extremely optimistic, you get really euphoric about the future, you're not really into details, maybe the VC world is the way to go, because the payoff structure is very different there. You just need one or two winners out of a few hundred, and you're going to do very well. And you've got to have that very different mindset. Someone with that VC mind going into the debt world is going to have a very bad time. Someone with that debt mindset or attitude going into the VC world is going to fail miserably. And then there's the stuff that's in between. And I think there it's just about understanding your own skills and where your interests are, and making sure that the approach you take suits. So I can take a lot of volatility in performance. I am willing to concentrate positions because I've had very positive experiences with them working out. I have seen the cases where they've blown up and why. And so if we can parameterize this correctly, we can avoid those problems. That's the bet I'm willing to make. And all of us at Maat have that same viewpoint. We all came together before we started the company and said, are we comfortable with this? There are people that I've worked with before. Brian, who's my former partner, does not view things the same way. He looks at it and says, I don't want anything more than, say, 10% at the most. 5% is ideal. Yet Brian will invest with us because he knows that I'm good at handling this stuff. If you look at Buffett, Druckenmiller, Joel Greenblatt, three totally different types of people, three totally different types of investor, the one thing they've got in common, they all concentrate. But they've got the temperament for it. Like Dino, as I mentioned to you earlier, he has the temperament for this. So doing that, if you're a nervous Nelly, it's a big no-no. Even if you understand conceptually that it can work well, you will not be able to stick with it. So it's I guess it's that old expression, to thine own self be true. Don't lie to yourself. Know who you are, know what your skills are, and then go to the area where your skills and your abilities and your temperament are well suited, and you will thrive. Trying to get a fish to climb a tree, you're not going to be successful.
Sure.
It's just
that makes sense. Makes a lot of sense. Yeah, and I really appreciate it, and I think that's a good way to round up the conversation. So it's been great speaking with you, Shaun, and I like the amount of experience, but also the stories and how you can kind of explain what you've experienced, whether it be around the GFC, whether it be in kind of mortgage-backed securities, or whether it be with kind of bottom-up stock picking and the different examples and the way you think about things. So always great to speak with you. Appreciate your time, and look forward to seeing how Maat can grow over time and really take off. Now you've got the new license, which will no doubt be very helpful for you.
Yeah, I'm sure it will be. Well, thank you so much for the time, Lewis. It was a pleasure as always, and I look forward to seeing you hopefully in person soon.
Yeah, absolutely. We need to catch up in person, don't we? I need to come to Germany, or hopefully I'll catch you in London sometime.